All right. So where are we? Okay, yeah. So just looking at the schedule, you already know this, but I will just reiterate, today's the 26th. Just what John was saying, chapter 14 homework is due today. We've known this for a while. We've been out of chapter 14 for a while as well. So you've had everything that you've needed, excuse me, to finish that homework. And completing that homework is obviously going to be helpful to be able to tackle the quiz and the test. The quiz and the test opened this morning at 9 a.m. They will remain available to everybody until November the 2nd at 6 p.m., at which that's the end of the window. Your responsibility is to find a few hours within the next week to complete the quiz, and then afterwards to complete the test. That you have ample time. The quiz is probably written to only take about maybe 30 or 40 minutes, but you have 2 hours because I know that people are getting used to the new Wiley system and so on. And then similarly, similarly the test I've over provisioned time. We've gone over what is in the quiz and the test. Last time, excuse me, I was doing a question out of chapter 13 that is similar to the last question in the chapter 13 homework, where you had to do a journalizing, you had to post to the ledger, and then you had to do a balance sheet. Today, in the first hour, I promised you guys that I would continue a little bit more. I'm not going back to that question because at this point we've basically covered the highlights of what that question entails. But I'm going to do I think the next thing was like a treasury stock question. And then I also just want to tackle some dividend stuff as well, just to make sure that I've at least covered most of what will be asked. Just bear with me. I'm looking for my attendance sheet and a few other things here. Okay. So we will spend some more time in review this morning for an hour or so, and then in the second hour we'll go back to chapter 15, which is where we left off the last time with the issuing of the bonds. Okay, so we are in the testing window. Please be smart about how you do this. Don't just jump in and say to yourself, "Oh, I'll see how it goes," and just blindly try the quiz or the test and hope for the best. Be strategic, study. Have the things that you need near to you. You know which exercises are coming in. Make sure that you're at least familiar with them and not planning to just kind of page through the notes or whatever to get to the answers. It's 15% of your grade, so it's not something small to just kind of ignore, and please don't leave it till the last minute. Again, I say this all the time, and there's at least one or two people who are going to leave it till the end, and then Murphy's law dictates that they will have every problem under the sun. They won't be able to open Wiley, they won't be able to open the questions, they will have an internet problem, and the new Wiley system is very difficult. Unlike the old one, it's very difficult for me to reopen the test and the quiz without you losing all your work. So we don't want to go down that road. So whatever you plan, please figure it out. If you're planning to do the test in the middle of the night or early hours of the morning, please know that I'm not necessarily going to be on my email, checking emails at that hour when you're sending me a frantic message that you've been locked out of Wiley. It's something that I'd have to deal with the Wiley representative. Clear the cache. Make sure the browser that you're using is the browser that you usually use to do the homework, so that you know that you have some history of this browser working with Wiley. Enable pop-ups on the Wiley website. manage your time. If you, I'm saying it all the time, and I know people are not listening to me. If you start the test and you get up and walk away and go and make a sandwich and have some tea and chat to your friends or whatever, the clock is ticking. All right. There's not much I can do if you come to me head in your hands to say I started the test and I thought, that if I close the browser that the timer would stop. It won't. It will just keep going. So yes, you can go in and out of the quiz and the test. You can go, you can save your work and go out, but that doesn't pause the clock. So please just remember that. So in the sense that try to choose a time to do the test and the quiz when you're not going to be bothered by, someone coming in asking you to do stuff. I know what it's like. We all have family, we all have friends, we all have people who are making constant demands on our time. So just think about a good time when no one is around to mess with your flow. Okay. So that's the information. You have it. Study. Okay, make sure that you are prepared. I will now let me see what I want to pick up here. Like I said, I'm not going to go back in depth into this question because I've covered the hard part of it, which is actually journalizing the stuff and posting it. I told you that the answer to stockholders' equity is available for you in the solutions. I know that, there may be questions about the solution. You're welcome to come to me, just like Steve was saying, welcome to email me or come to me in office hours. If the people who have emailed me in this class, I think they can attest to the fact that unless I'm super busy, it doesn't take me more than 24 hours to get back to you, unless you email me on a Friday night, because I don't work from Friday sunset to Saturday sunset. So it will take me more than 20. It's on the weekend. My response time, I've stated in the syllabus, is usually 48 hours, but I often get back to people within the hour. So don't be shy to email me if you're having problems with something that's bothering you, or you don't know how to answer a question on this homework for chapter 14, if you're still dealing with it today or whatever. Email me, maybe we can try and resolve the issue. Okay, so what I thought was I'd just go with you through how to do treasury stock. This is really just reviewing stuff to make sure that people are not completely lost, when it comes to knowing how to focus and to attack questions for the test. So there is going to be, right, I said to you, and I'm kind of just going down the line, there is the stock issuance entries, the general ledger and the balance sheet, which we spoke about last time. Then there's the treasury stock purchase and sale, which I'm about to go over with you. And then the question after that is allocation of dividends between preferred and common stockholders. I never, purported that I was going to do an example for every type of question that's coming up in the test. Some of the work has to be left over to you, but I'm trying to cover some of the things that I usually find that people struggle with a little bit. All right. So where do you find, if you are like, what on earth is going on? Where did these questions come from? I'm just looking at the practice questions that I gave you guys on the test prep sheet, and the solution is there as well. Like I was saying, to see at the start of the hour that some of the stuff I just need to review again, because there may be terminology or something or numbers of questions that are not exactly the same. So and I forgot to give you guys, I forgot to share this. Let me share the link also for this document with you on Blackboard. I'll just put it here in the test and quiz prep thing. I'll put it right at the top, so anyone who wants to join the sheet that I'm working on is welcome to do that.
Professor, I forgot to ask you also on chapter 14. I think it's question 2 or 3 that we didn't get to, like, it didn't let us know what's the right answer. You're supposed to check it. Can we go over it in class later? It's question 2, homework 14, question 2. It's supposed to be graded by the instructor, but it
Oh,
wasn't
yeah.
graded yet.
Yeah, but it won't be graded until the homework is due, because I have to leave it open until people can no longer change their answers. So if you're done with the homework and you want me to grade yours, I'm happy to do that. But the manual grading, just so you know, will always happen only after the deadline has passed, because if I start grading things before people have had the full time that they need to answer the questions, then they don't have even the possibility of amending their answer after the fact. Do you understand?
Mhm.
So
Yeah.
I can gladly look at yours and anybody else who's actually done with the homework. But for the rest of the people who are still busy, I will grade their stuff either after 6 o'clock tonight or tomorrow. Okay.
Okay, thank you.
Yeah, no worries. Okay, so why don't we look at this question over here, and this is what I meant, that the question numbers that I have over here, and maybe I've shot myself in the foot by even giving additional practice, right? That's like no good deed goes unpunished, because these question numbers are from the previous edition of the textbook. And often what the publisher does is, like, they'll add a question or they'll leave a question out in the next edition. So then all the question numbers are off, either by 1 or by 2, or some questions are just completely eliminated. So, if I were you, I wouldn't even consider this as a question that you could find in the textbook. I would just consider it as like exercise 2 on this page. All right. So don't go hunting down in the textbook, because I can't guarantee that it's going to be exactly the same question number with exactly the same information. All right, so let's go through it. It's Treasury Stock purchase and sale. Reinhardt Corporation purchased from its stockholders, so that's immediately a giveaway that it's Treasury Stock, 5,000 shares of its own previously issued stock for 255,000. So they give you a grand total, right, of what the company paid for the Treasury Stock. They don't tell you the per share number, and for the cost. And so immediately what you should be thinking about is, okay, you're going to make the journal entry, but you should also be thinking about calculating how much the treasury stock cost per share, because at that point you will know what number to use if that treasury stock is ever sold again. And so I'll, prepare the journal entry for the purchase of the treasury stock. They talk about the 3 sales of the treasury stock as well, and I'll see if I'll cover all of them. One of them might be below cost, so I may leave it out. All right, so there's no dates given, so I'll just go I'll just go one by one. So I'll still call this exercise 13-8, but I'll put all, right, exercise 2, and I'll also put treasury stock, so that the people who are actually going to refer to this document at some point while they're studying will know which question I'm talking about. All right. So for the purchase of the treasury stock, right, and again, all of this is chapter 13 work. We follow the cost method. We record a debit to treasury stock at the actual cost of the stock. So treasury stock debit, 255,000, and the credit is to cash for the same, right? We purchased our own stock. And if you look back to the question, it says that it was 5,000 shares. So here you can just calculate a cost per share. And so it's 255,000 divided by 5,000 shares. So it's $51 per share, right? So we need that because when we sell this treasury stock at some future point, we need to know how much to credit the treasury stock account for. So then there's the first sale that they talk about. They said later he sold 2,000 shares for $54 per share. So first you just deal with this on its own, 2,000 shares at $54 per share. So your first question is how much cash are you getting, right? So it's 2,000 shares times $54. That's the amount of cash that will be debited. Again, if you were sleeping or you don't know what's going on, we're practicing treasury stock journal entries in preparation for your tests that open today. So you debit cash with the number of shares times the sales price. Treasury stock is going to be the number of shares times the original cost. Okay, that's what we mean by the cost method. You're not going to use the $54 over here, you have to use the $51. So it's going to be 2,000 shares multiplied by $51. That's the cost method in action. And so that's also the reason why you needed to have a per share number so that you could know what to use in this transaction. All right. And then as we know from previous discussions, the difference goes to paid in capital, right? Sorry, paid in capital from treasury stock. And so you can just plug that number, or you can say it's $54 versus $51. So the difference is $3 multiplied by 2,000 is $6,000, right? I'll show you here. It's 54 minus 51 times 2,000 shares, or just plug the number. Questions on the sale? Oh, sorry. Okay, so that's sale number one, and then sale number two, it's kind of getting to, similar, but over here, they basically made the sale at cost. So you're gonna find that there's no paid in capital from treasury stock. So I'll do that one for you quickly. So this is sale two, right? Still cash is the number of shares, sorry, was it 2,000? I'm getting ahead of myself. Yeah, 2,000 shares at 51, okay. 2,000 shares times $51. That's going to be your cash debit. And your treasury stock is, right, the cost method. It's the number of shares times the original cost, which is the same as the cash, because the original cost of the shares is $51. So I'll just put here so you remember the shares were sold at the original cost, so no excess, right? You didn't make any extra money, so there's no paid in capital from treasury stock. That's the second scenario. And so you're getting, good practice here for treasury stock. The last one, they sell 1,000 shares at 60. So now we already know that cash is going to be, cash is going to be the number of shares times the sales price of 60, right? So 1,000 times 60, 60,000 treasury stock, number of shares, reminding us, right? Number of shares times the original cost. So not 60, but 1,000 times 51, right? So 51,000. And then your paid in capital from treasury stock is going to be the difference, 9,000, which can also be explained by 60 minus 51 is 9 times 1,000 shares. And that's how you do the initial purchase buyback of the treasury stock, and then various types of selling of the treasury stock after the fact. Does anybody have anything they want to add or question about the treasury stock? transactions? All right. Good. So that's number, let's see what we're knocking out here. That's number one, and number two knocked out. The next one we're gonna come to, I think, is allocation of dividends. Let me see what I'm doing here. All right. So hopefully everybody, if you're taking stuff down, hopefully you've had a chance to copy this. Otherwise, just access the link that I put there in Blackboard. So let's look at allocation of dividends between preferred and common stockholders, and then I'll see what other things I added here at the bottom. So we're getting into chapter 14 now, okay? And this is the question that I'm referring to. It will be exercise 5 on your test, is what I'm about to tackle here. All right. So Hair Corporation has 3,000 shares of 7%. So as soon as you see that percentage, you should already know that this is referring to preferred stock, because the percentage is basically talking about the dividend, right? That the annual dividend, $100 par value preferred stock outstanding. And outstanding means outside of the company. There's no shares held in the treasury at December 31, 2014. At that same date, the company declared a 105,000 cash dividend. So when it says that the company declared this dividend, you need to realize that the 105,000 is the overall dividend for the whole company. So it includes common and preferred stock. It's not just for the preferred stock, all right? And so most likely, right, the question is going to ask you how much is going to common stock, how much is going to preferred stock, and in this case with various scenarios, which I'll work through each one of them with you. Determine the dividend paid to preferred and common stockholders under the scenarios, as I just said. So the preferred stock is non-cumulative. So here's where you need to know your theory, right? The theory here with non-cumulative is that if the preferred stockholders do not get paid for the dividend in a particular year, it does not follow, to be paid in the next year. There's no dividend in arrears. It's like if you don't get paid to this year, you lose the dividend. All right. So what that means for us is that there's nothing that's going to be owed if there is no dividend in any particular year. And so it's non-cumulative, and the company has not missed dividends in previous years. So they're saying not only is it non-cumulative, but there's no dividends that's missed. It's kind of redundant, because even if the company had missed dividends in previous years, the fact that the preferred stock is non-cumulative means that there will never be dividends in arrears. So let's go in, or let me go in and help to answer this question. And I'm for exercise 3, or allocation of dividends, right? So when you're looking at this question, you know what we're talking about. So how do you tackle a question like this? The first thing you want to do is calculate the preferred dividend, the annual dividend for the preferred stock, because you need to know how much money has to go to the preferred stockholders anyway, right? And then you can see how much is the total dividend, and then you see how that total dividend is split between preferred and common stockholders. So my first point here would be annual, right? What is the annual preferred dividend? That's what I want to know. And we said before that this is a formula, right? It's going to be the number of shares. It's all multiplied, so it doesn't matter what order you put it in. Number of shares times the par value times the dividend percentage, or dividend percentage times the par value. Either or, doesn't matter. That's what the formula is for the preferred dividend annually. So if you go back to the question, it told us that the number of shares was 3,000, 7% is the dividend percentage, and 100 is the par value, right? So it's 3,000 shares, right? times $100 times 7%. And so I'll just do 3,000 times 100 times 7%. So it's going to be 21,000 per year. That's what the preferred dividend is. So now for number one, we have a non-cumulative, right? Non-cumulative preferred stock. This means that if the stockholders are not paid their dividend in a year, in any year, not just a year, in any year, the dividend does not carry over to the next year, i.e., it doesn't accumulate or become in arrears, right? So it's like use it or lose it with non-cumulative. And so the first scenario is that it says that it's non-cumulative and the company hasn't missed any previous dividends. The fact that they haven't missed previous dividends doesn't even really matter. So per the question, there are no dividends in arrears, right? So now when you're doing this in Wiley, you're not going to write out all this stuff. I'm writing for you how I'm thinking through it so that when you're doing the question, you can develop some type of methodology to think through how to handle the question. So now the total dividend, right? The total dividend is 105,000, right? So for 2014 preferred, or not preferred, let me put preferred dividend, right? The preferred dividend is going to be 21,000, and there's nothing for any prior years. So then it means that the 2014 common dividend or common stock dividend, or whatever you want to call it, or common stock, you can even write, is going to be 84,000. So that's the answer to the question, right? 105,000 is being split 21,000 to preferred stockholders and 84,000 to common stockholders. Remember, common stockholders have a residual interest, which means they kind of take the leftovers. So either they, maybe get nothing, or they get something, or they get a lot. There's no predictability to what they will get, because the dividend that's declared, the amount of dividend that's declared really will determine how much they'll get, and that's up to the board of directors of the company to decide how much money they actually want to declare in terms of a dividend. Does anybody have questions on this one? All right, I'll take these silences as consent to move on. Remember what we're doing. We are practicing for the test, right? So, you want to think about if you do have questions. In the second one, it says the preferred stock is non-cumulative. So it's still the same thing where, if the dividend isn't paid last year, then this year you don't owe them for last year, because if it's not paid in a year, it just doesn't accumulate to the next year. It's still non-cumulative. The company did not pay a dividend in each of the 2 previous years. So the question is trying to test you, or if you want to call it, to trick you in a way, because now they're saying, oh, a dividend wasn't paid for 2 years. Does that mean that we owe them the 2 previous years of dividends plus the current year? And the answer is no, because when it's non-cumulative, you only pay them for the current year, right? When a dividend is declared. So you still are non-cumulative. So no dividends for prior years would be in arrears or owed, even if not paid, right? So you're basically ignoring that. So ignore the fact that no dividends were paid in the previous 2 Yes, and this is only because it's non-cumulative, guys. You have to read the question and you have to understand what that means. Otherwise, you will absolutely get the question wrong. Okay. This is like the crux of why how I end up in the answer that I have. So then we end up with the same thinking. There's a total dividend of 105. The preferred dividend is 21,000. Notice how it's the same answer. The preferred dividend, sorry, this is me being lazy and it's not going so well. The preferred dividend is still 21,000, right? From, because we calculated before, this is the annual dividend. And then the common dividend or common stockholders will get what's remaining. And for whatever reason, the formula didn't want to work. I think that's because it was referring to the previous cells. So it's the same answer. Notice how it says non-cumulative and no dividends were paid in the previous years. Non-cumulative, right, no dividends in arrears. Let me see what the language was. Not missed any dividends in the previous years, right? And then this one, they haven't paid any dividends in the previous years, but it still ends up with the same answer because it's non-cumulative. When it's non-cumulative, you only pay the current year for preferred stockholders. When the preferred stock is non-cumulative, you only pay the current year's dividend to the preferred stockholders and ignore, basically you ignore anything that happened in prior years. It doesn't matter whether it was paid or it wasn't paid, the answer will still be the same. Now we come to the exciting part where it says, I mean, as exciting as accounting can get, right? Where it says that the preferred stock is now cumulative. Well, I'd say accounting is exciting to me. It may not be exciting to everybody. The preferred stock is cumulative and the company did not pay a dividend in each of the 2 previous years. So here we start getting some, an issue, because if it's cumulative and we didn't pay, then it means that we owe them the 2 previous years worth of money. Oh, people are laughing for my try jokes. Thank you. And sorry to, I think it's Sam was saying that he has a headache. I feel for you. Yesterday I had a headache from 7 a.m. until 11 p.m. and it didn't matter what I did. It didn't go away. So I'm sorry you have a headache as well. As an aside, and to anybody else who's not feeling well, I commiserate with you. So it's cumulative. So let's write this out, right? The preferred stock is cumulative. It's cumulative. So any dividends not paid in prior years have to be paid in the current year before we pay the current year's dividend and before we pay any common stock dividend, right? So you have to, this is like if you have an old bill from Con Edison and maybe you owe like 3 months worth of electricity. If you, let's say you owe $300 for 3 months worth of electricity, if you give them $50, they're going to apply the $50 to the oldest bill. They're not going to apply it to the newest bill. They're going to apply it to the thing that's 90 days old first and try and get your bill down from the oldest amount right down to the newest amount. And I mean, part of the reason they do that is the older the bill gets, the less likely someone is to pay it. So if you start paying something off, they always apply it to the oldest bill. It's the same here with the dividends. If we are owing preferred dividends and suddenly we do declare a dividend, we're always going to pay the earliest years first. So it says that it's for the prior 2 years. Did I say that? That is not paid in the prior Let me write it in. So if someone, so not paid in prior 2 years. So the total dividend is still the same, 105,000, but the answer is going to look different here because what are the prior 2 years before 2014, right? It's going to be 2012 and 2013, where we owed a preferred dividend, right? That we haven't paid yet. And guess what? The preferred dividend is the same amount every year. So it's a 21,000 that they need to get for 2012, 21,000 that they need to get for 2013. We're still okay because we have 105,000 to work with. Then we can pay them, right? The current year's dividend because we still have some money left over. So in the end, the preferred stockholders are going to get 21,000 times 3. I find that sometimes, what happened now? There's always this issue with some function in Google Sheets. I find that people sometimes read a question like this and they just hear the previous, or they just read the previous 2 years. And when they allocate the dividend, they just give the preferred stockholders 2 years worth of dividend. It's supposed to be 3. 2 years are in arrears, right? That's what we call a dividend in arrears, right? Those 2 years are from being in arrears, and then you still have to pay them the current year's dividend. So it's 3 times. It's best if you just write it out. So, oh word, what is going on today? It's best if you just write it out to make sure that you've accounted for all the years that are being mentioned in the question. And then for 2014's common dividend or common stock, however you want to refer to it, you're going to say the total dividend minus what goes to preferred. So common stock at that point only gets 42,000. All right, so that's how you answer the question when the dividend. Thank you. That's how you answer the question when the dividend is in arrears because the preferred stock is cumulative. And there is a question. I mean, it's not exactly like this in the sense that obviously the numbers are not the same per se, but I think the question that's on the test is the same like the allocation of dividend question that's in the homework, and the mechanics of what we are doing is the same, you know, regardless of how the question is structured. It's all the same thing. So you have to understand what's the difference between cumulative and non-cumulative. You have to understand how to calculate the preferred dividend. You have to understand when a dividend would be in arrears, and the fact that if it is in arrears, you have to pay off that dividend first before you can pay the current year, and you have to pay the preferred stock before you pay the common stock. And your best bet is not to try to cut corners and just come up with numbers on your calculator and say, oh, this must be the number. Your best bet is to actually write the problem out on, you know, scrap paper before you start typing stuff into Wiley, especially if it comes up, God forbid, but especially if it comes up saying that your answer is wrong. If you have proper notes that you can refer back to show you how you thought about it, you won't keep making the same mistakes. Okay, so please also think about testing strategy as you prepare to take the test, that you should be trying to keep proper notes of how you answer questions, so that again, if your submission turns out to be incorrect, you don't panic and start doing the thing from scratch. You can just look at your calculations and see where you may have to tweak something. Does anybody have questions on items 1 through 3 over here? Anything that you need me to further articulate, or are we okay?
I understood what you did. I'm just I wanted to ask, it says that with the exercise you gave us, it says allocating of dividends between preferred and common stockholders. That's what we did right now, right?
Mm-hmm.
And then in declaration journal entry, what is the declaration? Will it be the
Oh, you mean from a previous example? What you're asking me?
will
What
it
would
be
be
the common
Oh,
stock dividend distribute?
No, you know, it's
Or
even
common
easier than
stocks?
that. So let's say what is the
Sorry, it's not a dividend. I got confused.
It's okay. There is another question like that.
The cash dividends and the dividends payable.
That's fine.
This one.
Yeah, exactly. What is the
Okay.
dividend declaration journal entry? Very simple. They've simplified it so much that you don't even have to separate it. Separate in previous editions of the textbook, they used to separate the dividend payable between common and preferred stockholders, but now it's literally just cash dividends, 105,000, dividends payable, 105,000, and sometimes let's say it's for number 3. Sometimes the company will say something like preferred stock 63K common, right? So they keep track of what it is. But I mean, they have all these calculations anyway. You would not be asked to do, this narration on your answer. The point here is that you know how to allocate it here, and then the journal entry itself is just that old journal entry that we've always done: cash dividends, dividends payable.
Oh, okay. So it's kind of like, so we did it in example 3 from your practice, right? Cash dividends, declaration and payment. It's the same? Okay, perfect.
Okay. Good. Other questions? Let's see what else is going on here. If there's I'm trying to find I don't know if I have a stock dividend question here. They're all cash dividends. Yeah, this is just issuing stock for non-cash assets, which we've done. Yeah, the last question. Yeah, here's a stock dividend question. I want to go over with you guys. The cash dividend question is literally like debit cash dividends, credit dividends payable. I think we would be somewhat wasting time if we dealt with that. But stock dividends normally also a pain in the for some people. So I think we'll spend some time there, and then we'll see what else the time allows. So I'm gonna go to this last exercise here, which I think is it's E14-4, but I just want to see what number it is. So that's number 1, number 2, 3, 4, 5. So this is number 6 on this page. Okay. So on October the 31st, the stockholders' equity section of Heinz Company consists of common stock $500,000 and retained earnings $900,000. Right. So they're giving you beginning balances. Heinz is considering the following 2 courses of action: declaring a 5% stock dividend on the 50,000 $10 par value shares outstanding, or 2, effecting a 2-for-1 stock split that will reduce par value to $5 per share. The current market price is $14 per share. Okay, so what is going on? They're trying to think of 2 different ways to do this. I'm not going to ask you a question about discuss the impact of anything. I'm just going to I'll write out an answer for C, but you're not being asked you're not even going to see a question like this in the sense that of a comparison, but you do need to know how to do a stock dividend journal entry, which is what I'll do in A. And you also need to know, what the impact of a stock split is, which is more likely to be a multiple choice question. All right. So covering this is covering material that you need to know anyway. All right. So what is going on, right? So you've got this 500,000 of common stock, which is obviously the 50,000 shares times $10 per share. That's fine. This retained earnings is just showing that the company does have enough retained earnings to actually declare a dividend, right? That's important, just for FYI, not because you have to do anything with retained earnings. The current market price is obviously important because part of the work with the stock dividend is that you need to know the market price of the stock in order to record the stock dividend. You also need a percentage, right, of the stock dividend to know how many shares are in the dividend. I'm just going to go to the notes where we discuss stock dividends, and you can see highlighted a whole lot of stuff. when we have a stock dividend, we have to know how many shares are outstanding on the date of the dividend. You need to know the number of shares, and we use the fair market value of the shares for the debit to stock dividends. The journal entries, debit stock dividends, credit common stock dividends distributable. There's that name of that account that you were referring to. See, this is specifically when we have a stock dividend, and the credit is, the paid in capital in excess of either par or stated value. In this case, we have a par value on the common stock. Okay, so again, when you are studying, when you are doing this stuff, please note that these journal entries are basically always the same. It's the mechanics of what goes into the number that you have to be concerned with. When you look at stock dividends, you're looking at the number of shares in the stock dividend. So that's where that 5% in the question comes from, multiplied by the market price of the shares. And then the common stock dividend distributable sounds like what we always do with common stock. It's the number of shares in the stock dividend multiplied by the par value in this case. And then the paid in capital account is going to get the excess. So I'm going to work with you through how to calculate the stock dividend, to do the journal entry, and then we'll move on from there to the next part of this question. So this is A. So I'm going to write this as E14-4 or exercise 6 right on this page, or stock dividends. You'll be able to identify what question this is. So the first question you have to ask yourself is, what is the number of shares in the stock dividend, right? And the way you calculate that is a formula that is written as the number of shares outstanding on the declaration date multiplied by the stock dividend percentage. This is always the same. All right. So if there had been and we had a question like this where there was an extra share issue before we got to the stock dividend declaration date, you have to include all the shares, all the common stock that the company has outstanding at the declaration date. And so when we look at this one, it's a little bit simpler because it's just the 50,000. They haven't issued any additional shares. So it's the 50,000 shares multiplied by the 5% stock dividend. So 50,000 shares times 5%, right? Stock dividend. And so 50,000, just use the formula. So there are shares in the stock dividend. So this is the number that you will work with for the journal entry, okay? Not the 50,000, not some other number that you come up with. This is the number that we need when we are doing all the debits and the credits related to the stock dividend. So now to get to the actual journal entry, you always will debit stock dividend, and it's going to be the number of shares in the stock dividend times the market price, and the market price was given as $14 per share. That's how you get that debit, 2,500 times 14. Because remember, you're giving people stocks, but they can turn right around and go and sell it on the market if they want to for $14 per share. So the real value of what you're giving them is the number of shares times the price that the share is trading at right now. So 35,000. Then we come to this very long name, right? This account is used as a placeholder for common stock because we have not yet issued the shares. So we've got common stock dividend. Distributable is the name of the account, and it's going to take the number of shares. It's the same like what we do with common stock, number of shares times the par value, which in this case is 2,500 times, and I believe it's 10, but I'll go back and check. Yeah, $10 par value. Don't get confused with this $5 over here. This is a separate scenario, right? So it's 2,500 times $10 per share. That's going to be in the common stock dividend distributable account. Remember that this account, the nature of this account is that it is a stockholders equity account. It will be shown under paid in capital stock, because it's just a temporary account that is in there. But I don't mean temporary in the sense of permanent and temporary accounts for closing journal entries. I just mean an account that is used for a while until you actually issue the shares, and replace this account with common stock itself. And then we know that the dollar amount of debits and credits have to balance. So you've got a $10,000 excess, and that is going to be paid in capital in excess of for a par value, and it's common stock. And that's just the difference between the numbers. So this is the journal entry for the declaration of the stock dividend, right? Notice that you had to do a little bit of legwork before you could even make the journal entry. If you just took the 50,000 shares and multiplied them by 14, that would be incorrect. You're basically saying then that the company is doing 100% stock dividend. They're doubling the amount of shares that they have out. That's not true. It's only 5%. Now, this isn't asked for in the question, but I'm just going to show you. So I'm going to say not asked for, right? Not asked for in the question, but what is the journal entry when the shares are issued, right? And you maybe remember this from the work that we did in chapter 14. So when the shares are issued, I'll just do it over here. What you end up doing is you debit common stock dividend distributable to get rid of the account because you don't need it anymore. You were just using it temporarily, and you credit common stock because now the shares are actually outside being held by by people outside of the company. So this is when the stock dividend was declared and now the stock dividend is issued. All right, so that closes the loop for you in terms of this account, how it's created and how it is removed from the books. Questions up to there before I move into stock splits? All right, if this if this review is making you shaking your boots or something because you're like, what on earth is this woman talking about? It's foreign language or something, just do the chapter 14 homework. If you haven't started it already, you're already going to start getting reinforcement about what I'm talking about, and please study. As much as things, when we're in these chapters, a lot of things look quote unquote easy in the class because we're doing them together. You will have to spend some time on your own, right, to study and make sure that you know what's going on. It's okay if you don't know all the answers now, but you'll have to put in some time to get there. And so to move into part B, right? Prepare the journal entry for, if any, for the stock split. If no journal entry is required, explain why. So this is kind of a testing question to make sure that you understand that a stock split will never require a journal entry. Okay, there's no journal entry if you split the stock because there's no change to the common stock balance. There's no change to the paid in capital in excess of par. What if there's just no change? The only thing that changes is the par value of per share, and the market price of the stock will change also, but we don't journalize for that. All right. So I'll write it all down in the note. But again, the bottom line is for a stock split, there is no journal entry. All right. So let me make sure that I've actually marked this so you know where the answers begin and end. So part B, right? There is no journal entry required for a stock split because it does not change any of the balances in the company's general ledger. The stock split, or the 2-for-1, I'll call it the 2-for-1 stock split, doubles the number of shares in issue from 50,000 to 100,000, and halves the par value from $10 to $5. This then means that the common stock account balance remains at 500,000. The stock split will also change the market price of the stock, but the company does not record changes in market price, as that is not a transaction the company is involved in. All right, so now don't panic. You don't have to be able to write stuff like this out for the test or anything, but you do need to know that a stock split is not going to require a journal entry. There will be an increase in the number of shares. In this case, it's 2-for-1. So there were 50,000 shares. There'll now be 100,000 shares. Because the number of shares increases, the par value has to decrease because the common stock balance has to remain the same. If you go back to the question, it said that common stock was 500,000. The stock split cannot change this balance. It can't become more or less than what it was, right? Because there isn't an actual, transaction in the true sense of the word. They're just doubling the number of shares that are outstanding. So they have to halve the par value so they still end up back with 500,000. And then, like we said before, when we discussed stock splits at length, remember Apple has done a number of stock splits. The stock split is going to change the market price. It's going to probably halve the market price of the shares, but that's not something that the company records on its books. And the reason that we would even do a stock split is actually to make the shares what they call more marketable or more attractive, which basically amounts to just making the shares cheaper, so that people will be inclined to invest in the company. And we've seen this with Apple. They've done multiple stock splits, and always after the stock split, the stock price increases again, and again. So in effect, people are actually becoming richer after the stock split. So no one's really losing anything by by having the stock split, because if I had one share of this company for $14, all that's happening is that I now have two shares for $7 each, and the stock price will probably go up because more people will want to buy the stock now that it's cheaper. All right, so that's how you consider the impact of a stock split, and it's not really going to change the balances in the accounts. Not really, it doesn't change. And we've already discussed this, right? The impact on the common stock dollar amount, I just said that it will halve, and in fact I can write it here, the market price, and then the par value also halves the market price. Will likely be halved as well. And I say likely because sometimes the stock split is already priced into the stock price, and so people end up, the stock ends up not truly dropping by half because people are already trying to buy the stock after hours because they know that the price is going to go up. All right, so that's that. in terms of the review, I'm not going to spend any more time here. If you want to review more with me, you can come to office hours. Just to recap, we've gone over stock issuance, journal entries, ledger, and balance sheet. We've done a treasury stock example. We've done a stock dividend example. I didn't do cash dividends because it's really basic: debit, cash dividends, credit, dividends payable. And then I've done an allocation of dividends with you. The income statement, the example that you have in the book is that you do for homework is sufficient to be able to answer the question on the test. You just have to remember how to calculate tax. And then retained earnings balance calculation, we've done that several times. I think we did at least 3 or 4 examples in class, and you have, I think, 2 examples in your homework that you can practice. And if you have questions, obviously you can ask me about that. But I think these earlier topics, because these were the last 2 topics that we did, I think these earlier topics were the ones where people may still have had some lingering questions. I just wanted to say, because I think this was also what I think it was CEO, someone was talking about the manual graded question on the homework. I believe it's probably the question that asks you how is dividends payable and cash dividends or stock dividends, I can't remember, classified, in the balance sheet. Remember that dividends payable is a current liability, right? Because it's usually going to be paid within 1 year from the balance sheet date. And cash dividends and stock dividends are shown as a deduction from retained earnings. You can either say you can just say in the retained earnings statement. The retained earnings statement is really part of the stockholders' equity statement, but it's saying retained earnings statement is sufficient. If you want to be bothered with numbers when you answer that question, you can add up all the dividends that were declared, and you can say a cash dividends will be a deduction of 500,000 from retained earnings, and dividends payable of 50,000 is a current liability. But it's enough for me that you can just say dividends payable is a current liability, and that cash dividends or stock dividends, whichever one you're dealing with, will be a deduction from retained earnings in the statement. And the reason I'm saying that is because everybody has different dollar amounts for their questions. So you don't have to labor over trying to find the exact dollar amount. I'm more concerned that you actually just understand where these items go on the financial statements. Okay. So that's one of the questions in the chapter 14 homework. It's where it's asking you to manually type in to respond to where to classify these 2 items. Okay, so I'll end it there. Before we take a break, I just wanted to say that the registration opened yesterday. So if you forgot, or you were busy or whatever, just remember registration opened yesterday. Classes, especially online classes, are probably going to be pretty popular because a lot of people still want to be able to work from home or go to school from home. Don't forget to register for your classes. You don't have to pay as soon as you register. You're able to register. You can swap in and out of classes, and the payment date will only come in some time. So let's take a break until 11:50. I'm here if people want to ask me questions, and once we come back, we'll continue with the stuff we were doing on chapter 15. Okay, I may not be my head may not be on the screen because I'm looking for my pen, but if you have questions for me, just ask.
Professor,
Yeah.
I don't see any of the classes for spring semester or fall semester when I'm trying to enroll.
What does it say on your Uni First as your date when registration opens?
Where do you see it? If I go to Student Center.
I wonder if I should stop the recording, and if you're comfortable, you can share your screen with me, because I don't have to register for classes, so I'm kind of the only time when I've ever seen where this is shown is when I've helped my first year seminar students. and they've normally had it in CUNY first, Student Center, and then at the bottom right-hand corner. Shafak, can you help us? It looks like you just raised your hand. What's happening?
Sure. So what is it? You have to go on CUNY first and then click on Student Center, and
Yeah.
then next to your class schedule, there's an option for class search. So you can click there, and then you have to enter the institute you go to and the
Shafaq, I'm kind of
semester.
lost. Where do you see?
Okay,
I mean,
see, are you comfortable if I stop recording that you can show your screen, or are you not? Okay, so let me pause the recording and then and stop sharing my screen. I'll make you a co-host in the recording. All right, so where we left off last time, we had done the journal entries for, and I know this is kind of like a big switch now, right? To go from all that review that we were doing and switch to long-term liabilities. So, take a moment, take a deep breath, and kind of try to get your head back into, the previous work. But we had dealt with, this notion of bonds and the company raising money, not through issuing stock, but through issuing debt, and that they do it by way of a bond, and that a bond is a note payable, it's interest bearing, it is due in a number of years, so it's a long-term liability, and it can be issued at par or face, right? Par or face value, which was the first example that we did. You debit cash, you credit bonds payable with a face amount or par or 100%. And then we also did some interest calculations and interest accruals. And then we said a bond could also be issued at a discount, which was, if the company is giving an interest rate on the bond that is not as high as what the market is demanding, they may, knock off some of the price of the bond because they're trying to attract investors, but they don't want to pay higher interest rates. So they say, okay, fine, give us 92,000 today, and we'll give you 100,000 back in 5 years' time, but we'll still keep our lower interest rate. And because of that extra money that the people will get at the end of the life of the bond, they're willing to invest with the company. And we also said that bonds are actually a thing in life. I mean, you see it in the textbook. There was a bond that was shown of Twitter. There are other bonds on the bond exchange. But what is happening these days, as you've probably noticed and we spoke about to some extent, is that interest rates are very low. So if you choose a bond investment, it's lower risk than stocks, but the return is, not as high. If the Dow Jones is returning, for 2021, maybe already almost 20%, that the bonds are returning somewhere in the single digits, because it's low risk, low reward. That's how it goes, right? With a bond, you're going to get your money back. With stocks, you have no idea exactly what's going to happen. Yesterday, the Tesla stock went through the roof. Elon Musk, I think, added another 25 billion to his personal wealth. Tesla became the 5th company to hit $1 trillion market value, which means the number of stocks times the stock price. So anything can happen with stocks. With bonds, it's pretty much, you're just chugging along. You're getting your interest, and at the end, you will get your money back. So it's an investment that, is kind of secure, but there's not going to be a sudden, drastic change unless maybe you're trading bonds. And even then, it's kind of like not so great. And of course, you have to remember, and I'm not knocking bonds as an investment. I'm just saying that you have to be aware going into it that you're not going to return as much money as you would with some other investments. And of course, you have to, with any investment, take inflation into consideration. So we see now how prices are going up. In fact, yesterday I was reading an article about how this Thanksgiving will be the most expensive for food ever, because of all of the different supply chain issues and so on. So even the consumer price index is rising, and when you make an investment, you also have to consider, what the investment is returning versus inflation to make sure that you're at least beating inflation. So with the bond, yeah, these people are saying, hey, I don't want to only get a small interest rate, I need to get more money. So the company is like, fine, I'll discount the bond, I'll give you 100,000 at the end. A discount is a contra liability account. It gets subtracted from the bonds payable account to show what the carrying value of the bond is, right? There's the, and then the interest is still calculated on the face value of the bond. And the opposite side of this is a bond that is issued at a premium. So premium sounds like it's higher, right? Discount is lower, premium is higher. This is what happens if the company has an interest rate on their bond that is higher than what the market is offering. Then everybody wants to come and buy this company's bond. And in the end, all the demand for the bond pushes the price of the bond up. And so we say that the bond is issued at a premium. So here we have, right, this $100,000 face value, 5-year, 10% bond, but it's being issued for more than face value. It's being issued for 108,111, right? So 108% of face value. And so the cash that the company gets is higher than what they will pay back in the end. And the reason again for that is that there's just such a demand for their bond. And then this premium account picks up the difference between the cash that the company received and the actual liability that they'll have at the maturity date of the bond. And the premium is added onto the bonds payable account in the balance sheet to get to the carrying value. You'll see in the book, I can't remember if they still say it in the book, but the premium account, the type of account is called an adjunct account. It's kind of next to the bonds payable. So that's, just a refresher, because last time where we ended up was that we were doing exercise 2. We had already done the first 2 parts of that and we were going on to the third. So I'll just refresh what that was in exercise 2 so that people can kind of get back into the swing of things. So Phantom Company issues $100,000. That's the face value of 4 years. That's the time to maturity, the term of the bond. 10% is the contractual interest rate bonds on January the 1st, 2013. That's the issue date. You count the 4 years from this date to get to the maturity date. Interest is paid semi-annually, so every 6 months on July the 1st and January the 1st. Prepare the journal entries to record the issuance of the bond if they were issued at par. And so we did that. So it's easy. It's debit cash for 100,000, credit bonds payable for 100,000, right? Slam dunk, easy journal entry. And so then it says at 95, so 95% of par, so it's a discount. Remember, this percentage tells you how much cash you're going to end up getting. So 95% times 100,000, that's the cash. So cash is 95,000. The bond payable will always, I wrote this the last time, whether we issue the bond at the face value, at a discount, or at a premium, the credit to bonds payable will always be the face value. It will always reflect the liability that you will have at the end of the life of the bond. So you know that this 100,000 is always going to be a credit. And the difference between these two, the debit that's missing to make the debit and credit side equal, is this discount on bonds payable account, 5,000. It's a contra liability. And in the next part of, once I'm done with the premium account, I'll show you how the balance sheet looks. So now part 3, which is the premium, it says that it's issued at 102. Remember again that the 102 is referring to the actual cash, right? The cash is 102% of the face value. So we will debit cash, right, with 102% multiplied by 100,000. Right, and then the bond payable again will always be straight up 100,000. And so now you have a problem on the credit side, right? The credit side is too small. There's the 2,000. This is the new account called premium on bonds payable. And that's how you journalize the issuance of the bond at a premium. So these questions are always the same. You just have to check the percentage, right? The percentage will shift, depending on what the question's asking. You just use the percentage that is given in the question to apply that to face value to get to the amount of cash that is being, sorry, I'm just looking for something, to get to the amount of cash that is being received. Because that's really the cash received is really what drives the calculation. And then from that you can determine whether the discount or the premium exists and so on. So so that's that answer. And then we go to show how the long-term liability section of the balance sheet would look following the bond issues in A. So it's basically 3 rounds of showing the balance sheet when the bonds are issued at face, when they're issued at discount and at premium. And then afterwards we do an interest calculation quickly. No, I can't find all over the place today. I can't find my sheet. We have to sign on. It doesn't matter. It's fine. I'll just continue without it. All right. So part B. So when we're doing the balance sheet, I guess for the first go around, we can put the company's name. Sorry, Phantom Company. Right? Do we have a year? Okay, so it's 2013. So we're gonna say balance sheet, and it's partial. That's a partial balance sheet. Let's just say we're doing it on the day of the issuance, right? Because if I do it at the end of the year, there's extra complications that we don't need to go into. And so obviously the bond, the whole stuff to do with the bond will be in the liabilities and stockholders' equity section of the balance sheet. When you look in the book, they don't go to this extent. They just start with long-term liabilities. But I always want to remind you that the balance sheet consists of 3 major categories. There's assets there's liabilities, and then there's stockholders' equity. And the liabilities and stockholders' equity sections are shown together. So then you put long-term liabilities, because you will classify, if you remember anything from accounting 1, which it's okay if you don't, but you classify your long-term you classify your liabilities between long-term and current, right? This is chapter 4, classified balance sheet, if this rings any bells. So that's how you're going to end up separating the liabilities out. The assets are classified by the length of time, but also by their nature. So for A, for number 1 or whatever you want to call it, from part A, there was, let's do it this way. There was the just straight bonds payable is gonna be what you'll do, and it's gonna be 100,000. This is the balance sheet for the bond issued at par or face value. That's how it looks. All right, nothing special. Number 2 is where things start getting interesting, when the bond is issued at a discount. You still put bonds payable at 100,000, because obviously that's what you recorded at. That's what the journal entry was, so that's what the ledger is going to be. But then you're going to say less, you're going to subtract discount on bonds payable, and that's the 5,000, right, from before over here. We're just showing how these amounts end up looking in the balance sheet. And so what you do is subtract the 5,000 from the 100,000 to get to 95,000. And this is referred to as the carrying value of the bond, right? And just so we know, this is the balance sheet for the bond issued at a discount. And then the last one, number 3, pulling the information from above again. Notice how bonds payable again is straight face value 100,000, but to that you will add the premium on bonds payable. And that comes from over here, it's 2,000. So your carrying value is going to be above face, right? It's going to be 102,000. So this is also the carrying value of the bond, and this is balance sheet for bond issued at a premium. So what do we see that's important here? When there's a discount, the discount is subtracted from the face value. When there's a premium, the premium is added to the face value on the balance sheet to get to the carrying value of the bond. When the bond is issued at face, there's no adjustment to the bond amount. All right, so natural follow on from the journal entry to see what it looks like on your balance sheet. Questions, anybody, before I go into the thing asking about interest? All right, so no questions at this time. So let me go and read part C. So part C says, show the journal entry for the payment of bond interest. That's the first semi-annual payment, right? On July the 1st, 2013, assuming that the bonds were issued at face value. So they make it easy for you. You're just going to calculate the interest based on face value. You don't have to worry about a discount or premium, what we would call amortization. As part of this. It's outside the scope of our work in this class anyway. You'll do it in intermediate accounting too, should you continue with accounting. So part C, we're going to do an interest, right? Interest calculation. As a reminder, right? The interest calculation is the face value of the bond multiplied by the annual interest rate multiplied by time in terms of 1 year. So how many months out of the year? So it's going to be 100,000, just to write it out to show what we're doing, multiplied by 10%, multiplied by 6 months out of 12 months, because between January the 1st and July the 1st, 6 months have passed. So we need to do debits and credits here. And it's an interest payment, so cash has to be involved. It's not an accrual, at which point interest expense, excuse me, would be involved. So I should have probably just put this here to just show where the 5,000 I'm going to use is coming from. So interest expense is a debit of 5,000, and then cash is a credit of 5,000, and that's the end of that exercise. All right, so questions, anybody? Seems like we are okay with that. So then I'll go into talking a little bit about what happens when we have to pay the bond back. It's called retirement. There's all these R words, okay? You can either call it retirement, redemption, or repayment. It's, oh, sorry, Michelle, go ahead.
I'm sorry, Professor. For discount, it's always going to be considered less, right?
Yeah.
Okay.
Mhm.
Okay.
Anything else, guys? All right. So the next piece now, we're moving away from selling the bonds, issuing the bonds. We're now moving into paying them back, paying people back. in whatever way we need to pay them back. And so, like I said, these three R words, they basically mean the same thing: retirement, repayment, or redemption. We're basically settling our debt, okay? And excuse me, the bond can be redeemed or repaid. Again, redeeming, redemption, repayment, it's all the same thing. It can be repaid at maturity, which means at the last date that you have to pay it back. But it can also be repaid before maturity, before the end of the life of the bond. And you see it here, that's before maturity or at maturity. And it's repaid sometimes before maturity. The company actually writes into the bond agreement that they should be allowed to repay it before maturity, because sometimes they want to hedge if they suspect that interest rates may drop fairly drastically, that they want to be able to pay back a high interest bond so that they don't have to, keep paying these high levels of interest when the market interest rate has gone down considerably. And for various other reasons, they may want to be able to repay the bond before maturity. But let's start with, kind of like the classic normal case, right? Redeeming a bond at maturity. What does that mean? So, in terms of journal entries, right? That's what I'm saying, not what does that mean in an existential sense. A company which issued bonds retires the bonds, takes them off the books, either when it redeems or repays them, or when the bondholders may convert them to common stock. That's not something that I've discussed yet, but it's possible sometimes, especially in some of these like startups and some of the stuff that happens in Silicon Valley. Sometimes companies will not be comfortable investing in your equity yet when you're just starting out. So they'll give you a loan, maybe in the form of a bond, and then they'll say when you reach a certain milestone in your business, then that loan converts to stock. So you don't have to pay it back, but they will then own a piece of the company. So there could also be a conversion to common stock out of the bond and into common stock. But again, let's just focus on redeeming the bond at maturity for the time being. If it's redeemed at maturity, redeeming means repaying the bond, regardless of whether, this is very important, okay? Regardless of whether a bond was issued at a discount or a premium or at face value, doesn't matter. The book value or carrying value of the bond at maturity will be equal to face value. So you just saw here in these examples that we did, right, that the carrying value of these two bonds are not the same as the face value of 100,000. But what this note is saying is that by the time we get to maturity, and I've mentioned this in the previous class, that discount and that premium is going to get smaller and smaller over time, so that in the end you're just left with 100,000 to pay back. And there's a way that happens. Like I said, it's called amortization, but we don't have to go deep into it. I think it's in the appendix if you really want to go in there or torture yourself, right, to read it. It's not that hard, but it's not necessary for you to go into it. All you need to know is that by the time we reach the 4 years or the 5 years, the end of the life of the bond, that the company will only have on its books the face value of the bond, even though it had been issued at a discount or premium. And so the journal entry for the redemption/repayment of the bond at maturity is actually very simple, because it is just the reverse or the flip of the journal entry for issuing the bond at face value. Remember when we issued the bond at face value, we said debit cash. I'm just going to go back up. We said debit cash and credit bonds payable, right? We recognize the cash that we received, and we also show the liability that we owe. When we redeem the bond at maturity, it's just the opposite of that. We say debit the liability because the liability is going down with the face value amount, and credit cash because we have to pay out cash. That's it, okay, for bonds at maturity. So exercise 3, I'm going to let you guys do it. It's basically the same thing as what I just said now, just so that you can wake up or practice or pay some attention to the material here if you have other things going on. Let's read it together, but then you'll do the journal entry. Hybrid company issued $2 million, that's the face value, of 7% annual interest rate 5-year bonds. So this is the term of the bond on January the 1st, 2008. So the 5 years is counted from 2008, January 1 at face value. So you don't even have to worry about discounts and premiums. On January the 1st, 2013, so it's 2008 is when they issue it. So 2009, 10, 11, 12, 13. So 5 years have passed. So this is a redemption at maturity, right? Hybrids redeems the bonds. Prepare the journal entry for the redemption of the bonds. So I'm going to give you guys, let's say, 4 minutes to do the journal entry for the redemption of the bonds. And then I'll have someone raise their hand to answer the question for us. Okay, so you have until 12:26 to answer this question.
Professor, can you scroll back to the previous solution?
Yeah, so whoever still needs this question, just take a picture quickly or do whatever you gotta do. And then I'm gonna go back because people wanna see what's happening. Are you talking about this?
Yeah.
All right. Remember, this is a redemption at maturity. So you're basically just flipping the bond issuance journal entry around, okay? It's not a difficult.
I'm back. I'm back. Professor, I'm sorry. My internet just shut down for a second.
All right, so we're doing, so Shafak, are you done with looking at this thing?
Yeah, Professor.
Okay, so we're doing exercise 3 over here. The class is doing it.
Exercise there. All right. Thank you.
Mhm.
Professor, when did registration for spring, for this coming spring semester opened up anyway?
Yesterday. So according to the powers that be, yesterday.
Yesterday. Oh,
Mhm.
okay.
Mhm.
So not just for, I'm freaking out. I'm so stressed about
Don't
it right
freak
now.
out, don't freak out.
I
I
really
will
need
help you.
online classes because
Mhm.
I moved. I don't live in Queens anymore. And
Mhm.
now I'm scared that I'm gonna miss a semester because
Don't
of
worry.
it.
I will stay on at the end. I will help you, okay? We will try and do whatever we can.
Thank you.
All right, we're rounding the corner here on the time to finish this journal entry. Is there anybody who wants to give me the journal entry? I can wait all the time. Right, again, the floor is open. Who wants to give us this journal entry? It's 2 accounts and 2 numbers. Let's go, people. I know there's someone out there who has done it. Don't be shy. No takers? Boo. Okay, I'll give you guys grace. I'm not gonna let you get off the hook so easily again, okay? But we've had a long. Oh, Scarland, you saved me from myself. Thank you. Go ahead.
Bonds payable, 2 million.
Sorry, I didn't hear you properly there for a second, but you're right. Funds payable, debit 2 million because the liability is going down, and then
Cash credit, 2 million.
as simple as that. Thank you. Cash 2 million. So this journal entry was the same thing that we were just discussing over here, right? That when the bond is redeemed at maturity, the journal entry is debit bonds payable with the face value of the bond and credit cash with the face value of the bond. It's the same every time, okay? And it's also just the reverse or the opposite, however you want to call it, of the issuance journal entry. It's the same thing, just flipped over to show that you are now getting rid of the liability and you are paying out cash. Thank you, Scarlett. Does anybody have questions about this journal entry? It's probably easier than you suspected when you were not feeling up to answering the question. Anybody questions about it or want me to explain something else? All right, so don't get confused. All right, this is the repayment of the bond. The previous entries that we made were the selling of the bond. So you got to keep your debits and credits in order. So let's continue here and talk a little bit more about redeeming bonds. There is a situation where you and thanks, Garland, I appreciate it, where you redeem bonds or you could redeem bonds before maturity. As I said, a company may decide that they want to pay back the bond before the date at which it's actually due. And if they gave themselves that option in the bond agreement, they are allowed to do it. But it does come with a little bit of complication because especially if the bond was issued at a premium or a discount, that premium or discount would not have been fully amortized or realized before maturity. So when we do the journal entry to record the redemption of bonds before maturity, there are a number of steps that we have to follow in order to make sure that we account for everything that's still on the books, right? So when a company retires bonds before maturity, it has to complete 3 steps. And these steps are also shown in your text. And let me actually just go there to show you, because, you know, the way I wrote it here looks a little bit dense, like busy, but I think there's a page in the book that makes it, that shows it a little less dense. Okay, someone needs to leave. Okay, that's fine. Thank you for letting me know, Michelle. So here we go with chapter 15 and bond transactions. Let me see.
Professor, question, are you recording? I'm just
Yeah.
want to make sure.
Yeah, I am.
Oh, okay.
Thanks for checking. So I don't end up with another like sad state of affairs, right? Where I forgot to record the whole class or something. Let me see. I think I've just gone past it. Yeah, redeeming bonds before maturity. Yeah, okay. So you have 3 steps that you need to follow. Someone, Three steps that you need to follow when you redeem the bond before maturity. I have those same 3 steps in our notes. I'll go back to the notes, but in the notes, I just explain even more, so it can look a little bit much to read initially. But you eliminate the carrying value of the bond at the redemption date. The carrying value includes both the face value of the bond and the discount or the premium. You record any cash that you paid to the bondholders, and then there is the possibility of having a gain or a loss on redemption. So this gets a little bit wild here. In, this is probably the part of this work that is a little bit trickier. So, pay attention, but obviously next time I'll go over it again. But there are these 3 steps. You have to know what carrying value means, right? The carrying value of the bond is the face value of the bond less any discount or plus any premium. We were just doing that over here when we did the balance sheet. Remember, I kept saying this is the carrying value of the bond. It's the face value minus the discount, or the face value plus the premium. When you redeem the bond before maturity, you have to get rid of the carrying value of the bond from your books. You have to record cash. So cash paid is going to be a credit, and then you either have a gain, which is a credit, or a loss, which is a debit. Those are the steps that you follow, right? So when you look at what I wrote over here, it's basically the same thing. Remove the carrying value of the bond. So carrying value is bonds payable plus the premium, or bonds payable minus the discount. But then I actually give how the journal entry needs to look. You will debit the bonds payable account to get rid of it, right? Because bonds payable is normally a credit balance. So to make it 0, you have to debit it. You will debit, if there's a premium on bonds payable, you will debit the premium on bonds payable to get rid of it, because it usually has a credit balance. So to make it 0, we have to debit it. And this is, your brain is probably spinning a little bit. It's okay. It's going to take a few repetitions to get this to stick, because what you're doing is you do it, when we were issuing the bond at a premium, we were crediting the premium account. Now that we're redeeming the bond, the premium account has to go away, and the way to get rid of a credit balance is to debit that account, right? And for the discount is usually a debit balance. You saw it over here. I'll just go back up to remind everybody what I'm talking about, right? When you do the issuance of the bond, the discount is usually a debit balance. If you want this debit balance to go down to 0, you will have to credit the account, right? The premium is usually a credit balance. If you want that account to go down to 0, you will have to debit it. Bonds payable is always a credit balance. If you want it to go down to 0, you will have to debit it. This is exactly what I'm saying over here. I'm walking you through how to remove the carrying value of the bonds, right? And then recording the cash paid to bondholders, that will be a credit to cash, and the question will tell you at what percentage you pay these people. I'm not going to read all of this now because you're going to lose the plot here and get mad at me. But all I'll say is that there's a way to figure this out, and I'll show you in an example. And then you recognize a gain or loss on redemption. Like I said, a gain is going to be a credit, a loss is a debit. If the cash we paid to the bondholders is more than the carrying value of the bond, we overpaid to settle our debt, so that is a loss. If the cash paid is less than the carrying value, we underpaid to settle our debt, so we have a gain. So you can see where the book is giving you 3 sentences. I'm basically writing out half a page to try and explain to you how this works. I'll do one example of this. Hopefully you'll stick with me. It's okay if you don't, if it's hard, because when we come back next time, I'll review it and we'll keep doing examples until most people know what's going on. Okay. So let me go into exercise. Where am I? Exercise 4. I'm going to do part A. This is a redemption before maturity. So I'll read it and then I'll take you through the steps as discussed previously. Hybrid company issued 2 million. So this is basically the same fact pattern as before. 2 million of 7%. That's the dividend percentage. 5-year bonds on January the 1st, 2008. They had issued those bonds at a premium. Right, so you should realize that there's going to be a premium on bonds payable account floating around on the books, right? So the carrying value of this bond is going to be the face value plus any premium. On January the 1st, 2012, so that's 2009, 10, 11, 12, that's 4 years have passed, which means it's before maturity because maturity would have been 5 years. So they retire the bond before maturity. Prepare the journal entry to record the retirement of the bonds. They tell us, right, before maturity at 98. So what on earth does that mean, right? What is at 98? And so I wrote here for you, this refers to the amount of cash that was actually paid. 98 means 98% of 2 million is the amount of cash that we've paid. Assume the balance in the premium on bonds payable was $7,000 at the time of the redemption. And remember that this is a normal credit balance. This is me writing in extra things that you wouldn't normally get in a question, just to kind of steer the conversation. So the situation now is laid out, and now it's a matter of following those 3 steps to be able to make the journal entry to answer this question. And what are the 3 steps? They're the ones that I just went over a second ago. Okay, so exercise 4, let's see if we can make head or tail of what's going on here. So exercise 4, right, you need debits and credits because of the journal entries. And so in step 1, right, we have to remove the carrying value of the bond, which means we have to debit bonds payable. And since there's a premium in this question, we also have to debit the premium on bonds payable. If we go back to the question, bonds payable will be at face value 2 million, and the premium is 7,000. So that's what I'm going to start doing. I'm just following the instructions of how I should treat this redemption. Step 1 is bonds payable debit to get rid of the liability, following those rules that I created. And then the premium on bonds payable, usually a credit balance, because I am eliminating the balance, I am now debiting the balance with the 7,000 that the question tells me is the balance on the account. All right, that is the end of step 1. Going on to step 2, record the cash that is paid to the bondholders. The cash was 98% of 2 million, right? It says that we redeemed it at 98. So I will credit cash with 2 million multiplied by 98%. So cash is 1,960,000. All right, so I'm obviously not done yet. I have options here. I can say, okay, on the debit side, I have 2,007,000. On the credit side, I only have 1,960,000. So it's clear that I'm still missing some amount on the credit side. So this is kind of the quick and dirty way of figuring out that there's a gain. I can say, okay, add up my debits, right? Add the 2 debits and subtract the credit, and I end up plugging the gain because I'm saying, okay, debit and credit dollar amounts have to be the same. So I'm plugging the 47,000 as a gain on, okay, gain on redemption 47,000. But you probably also want to know how do we get to that answer, right? And why is it a gain? Because we already said, and I'll go back here again, how do we know a gain is a credit? Okay, this is step 3. Recognize the gain or the loss. You have to memorize, if you don't know this, that a gain has a credit balance and a loss has a debit balance. So step 1 was removing the carrying value. Sorry, I forgot to add this in. Step 2 is the cash. And step 3 is calculating the gain or the loss on redemption. Yeah, I got it. Thanks for Denisa for telling me. Hopefully she can catch the rest of us on the recording. So if we didn't just plug the number, how would we recognize, or not recognize, how would we calculate the gain? Here we have the rule for how to calculate a gain or a loss. You compare the cash that you paid to the people to the carrying value, right? So to calculate gain or loss, you're going to say what is the cash paid, and you're going to say what is the carrying value of the bond. So the cash paid, we've got it already, right? It's 1,960,000. And the carrying value of the bond is it's these two numbers together. It's 2,007,000, because it's going to be the face value plus the premium. Okay. So what's the rule? If the cash paid is less than the carrying value, we underpaid to settle our debt, so we made a gain. All right, you underpaid because you owed, like this is what you owe, this is what we owe. Let me open this up. This is what we owe, and this is what we paid. So it's like someone saying to you, oh, you owe me $100, but you only have to pay me $90. That means you made a gain of $10 because they told you you don't have to pay them the whole amount. Yeah, we owed 2,007,000, but we could settle our debt with 1,960,000. So we made a gain of 47,000. So that's bond redemption before maturity. We still have a number of examples that we'll do on Wednesday when we get together again. I'm going to leave it there. I'm going to also just remind you again that the test and the quiz are open. You need to study. You need to do the quiz before you do the test. Be aware of saving your work, even if you decide not to submit immediately as you go through. Save your stuff, even if submission happens at a later time, because if your internet goes out or you get thrown out of Wiley for whatever reason, you end up losing anything that is not saved. And remember, the clock keeps ticking. So if you don't save as you go along, and your internet, a number of people just got thrown off the internet during this class. If your internet goes out, when you go back in, none of your work will be saved and you'll be running out of time. That doesn't mean submit. Save for later is different from submit. Okay. So you guys are dismissed. Go and good luck on the quiz and the test. I'll still hang around, and I've got office hours at 1 o'clock if anybody needs to see me. Abduz, I needed to just talk to you for 1 second here at the end of class. Abduz, just about that issue you were having with Wiley. Everybody else, you're dismissed. Have a good day. See, just stay on so that I can get the details and try to help you as well. Okay.
Have a good day, Professor.
You too.